Good afternoon, everybody. This is Jennifer Schaus, and we are coming to you live today from Washington, D.C. Thank you for joining us in our complimentary webinar Wednesday series. On Wednesdays, we cover the FAR supplements, and today we are covering the Federal Employee Health Benefits, which is part of OPM. We've got Susan Ebner with us, and she's with the law firm Stinson. You probably found out about our webinar today through our newsletter, which now reaches over 23,000 federal government contractors. And our webinars are all posted on our YouTube channel, which now has over 540 complimentary videos. If anyone's interested in sponsorship or advertising in the newsletter on the webinars, you can shoot us an email to the hello@jenniferschaus.com email address. About today's series, all our webinars are complimentary. Again, they're recorded on our website and posted on the YouTube channel. They take place Wednesdays at 12 o'clock. And the FAR supplements are covering the federal acquisition regulations for the specific department or agency procurement rules and regulations. Our speakers are typically subject matter experts, and today we've got a government contracts attorney, as I mentioned, Susan Ebner from Stinson. Here's the schedule, where we've been and where we're going. So we started the year out in January covering just kind of the basics on FAR, went through most of DOD. Today we are a little bit past the halfway mark, covering again FEHB. We'll wrap up at the end of August covering the Veterans Affairs. And then on Fridays, we have a corresponding Playbook series, which covers more of the sales, marketing and business development, tactical strategies that you can deploy to sell your products, services, or software to these departments or agencies. Again, we'll wrap up in August on Friday the 26th with the Veterans Affairs. Now we want to thank our sponsors. First up is the Virginia PTAC, and the Virginia PTAC is the Procurement Technical Assistance Center. There's one in every state, and they are typically co-located with the university. So Virginia PTAC has been a longtime partner and friend to us. They're based out of the George Mason University in Fairfax. They offer free one-on-one counseling to firms in Virginia on federal, state, and local procurement topics. Online resources and group trainings are free with no restriction on your business location. If you're interested in learning more, please use the links provided to explore what PTACs can offer. You also have a phone number there. We also want to thank our friends at the Federal Business Council, the FBC. The FBC creates and manages virtual and in-person meetings and events to connect government thought leaders, product providers, and solutions with government programs that use them. The Federal Business Council works within mission-specific programs for a variety of agencies to connect government and industry in the form of in-person and virtual conferences, training events, policy dialogue, and outreach. Over the last 40+ years, the FBC has become a comprehensive resource for connecting industry and federal government. Next up is Daston. Daston is an IT and cloud solutions provider working with corporations, the military, and government agencies to lower their cost, increase scalability, improve operational efficiency, and meet compliance regulations using targeted cloud-based solutions. Daston is a certified partner of Oracle NetSuite, a premier tier Google Cloud partner, and a certified partner of Cisco, Virtue, AODocs, and Authenticate. For more information about Daston services or to schedule a call, please email Joe Alston. You've got his contact information in the lower left corner. You can also hop onto their website. Okay, the reason that we are all here today is to cover the FAR supplement on federal employee health benefits. And we are joined again, as I mentioned, by Susan Ebner. She's with Stinson. I'm going to mute myself and put you guys in the good hands of Susan. Susan, thanks so much for joining us, and the floor is all yours.
Thanks, Jennifer. Always a pleasure to be with you. I think this kind of program is just a wonderful opportunity for folks to have a top-level view of some of the key acquisition rules that are out there, so that as you go forward, you know what you have to do. I currently chair the Government Contracts and Investigations Practice Group at Stinson, doing government contracting for more than 30 years. I'm the immediate past chair of the American Bar Association Public Contract Law Section and a director of the Procurement Roundtable. In terms of the kinds of work that I do, I started in government and was an in-house counsel attorney and am currently outside counsel, advising small and large businesses and nonprofits on government contracts, pretty much soup to nuts, dealing with all different kinds of issues. Before we got started today, I told Jennifer that I had a connection to the federal employee health benefits acquisition rules. When I was a young attorney, my very first government contracts trial was actually one that involved the FEHB. I got approached one day because the attorney that was in my office who handled all those cases had a heart attack and couldn't handle a trial coming up at the end of the month. I got tapped because I had touched a government contract during my 2L year in law school, and the rest was history. I tried that case and at the end of it said, I want to do more on government contracts. So it's a great area and it's always interesting, a lot of new issues. And even health benefits can have a lot of interesting and challenging issues. So knowing the rules is really important. Let's go to the next slide. Just as a sort of overview, Jennifer's already mentioned that the Office of Personnel Management, or OPM as we call it, not to be confused with OMB. OMB is the part of the Executive Office of the President and oversees all of the different executive branch agencies and entities. OPM is the agency that is tasked with administering federal employee matters. It administers the Federal Employee Health Benefits Program, FEHB, and that is under Chapter 89 of Title V, and it provides health insurance to federal employees, annuitants, their family members, and if there happens to be a divorce or somebody passes away, their former spouses, to the extent that they're still covered by their plans. The Federal Health Benefits Acquisition Regulations, they've been calling them the FEHBAR, that's a mouthful. I'll probably just be calling them the Health Benefits Regulations, are for acquiring and administering the kinds of contracts that deal with the administration of the health benefits system. Interestingly, like other government contracts, it's got an order of precedence. When you look at clauses, when you look at the requirements, what is that order of what complies? Always the law comes first, 5 U.S.C. Chapter 89, then the implementing regulations. These are found at 5 CFR Part 890, and then the FAR. The FAR will address all federal health benefits kinds of contracts to the extent that there isn't a superseding federal employee health benefits acquisition regulation. And then after that, the federal employee health benefits contract, which is a little bit different when you think about a normal dispute. Normally the contract governs, but these laws, rules, and regulations under the order of precedence that has been established here under the code, this is how the order runs. So the FAR will supplement what isn't listed in the Federal Employee Health Benefits Regulation. So if you don't see it, then you go to the FAR to try and fill in the gaps. And then there is, of course, case law. If you go to the next slide, not only internal procedures, instructions, and guidance, but the Armed Services Board of Contract Appeals handles cases. When I had my health benefits, that very first one way back when, it was at the Armed Services Board of Contract Appeals, and they still have jurisdiction over it under that Disputes Act mechanism. There are more than 200 healthcare plan choices that are out there in the federal program, and the government can pay up to 75% of those plans. This federal employee health plan that we're going to talk about the rules for today is actually the largest employer-sponsored health program in the entire world. It was started in 1959 and has been around for quite a long time. Next slide. So some of the key definitions I wanted to cover, there are lots of definitions. One of the things about health benefits is that it's handled a little bit differently. The pricing is a little bit different. The terminology is a little bit different. But the more you work with it, the more familiar you'll become with it. So government contractors are frequently referred to as carriers. Carriers are those associations, corporations, and other entities that are not governmental, that are involved in providing, delivering, paying, or reimbursing healthcare services under the group insurance policies and plans that are covered by the FEHB. Notably, hospitals aren't typically considered carriers. Health services corporations and other entities are. A community rate is defined as the rate that somebody pays under a plan. That rate, depending upon how the contract is set out, would be based on experience or based on costs. Community rates can be adjusted based on the experience over the life of the contract as well. Usually the adjustments happen 8 months or more before the contract for that year starts. Next slide, please. So what are carriers responsible for, by the way? I mean, carriers are responsible for adjudicating claims, providing health benefits to enrollees and covered family members, and complying with the OPM rules. They have to issue these things called brochures. That really is the essence of the contract between the carrier and the community member who signs up, enrolls in the plan. That brochure has to lay out all the terms and conditions of the plan, and they rely on those terms and conditions. So if there is later a dispute about, whether somebody's entitled to reimbursement under the healthcare plan, they're going to look at what is in that brochure, what is it that was promised, and the dispute mechanisms, which we'll talk about later, will apply. As I said before, the federal employee health benefits, they sort of have a bunch of different calculations. We don't have the time to go through them. They're very involved. So depending upon whether you've got, one kind of contractor or another, you have different mechanisms for doing it. But a large provider is, the Blue Cross Blue Shields, the Aetnas of the world, and others who have very large FEHB contracts and whose federal employee contracts comprise at least 25% of their total contracts. They also have to be a vendor of the services, so you could have, insurance or other things underwriting the contracts, but you wouldn't be considered a carrier. You would be considered somebody who might be a subcontractor to a carrier, for example. So a vendor of services like a pharmacy, a health benefits provider, a mental health benefits provider. Those are the kinds of entities that are going to be covered by the large provider definitions. As it says here, carrier does not include local health plans that serve under an umbrella arrangement. So if you have, for example, a carrier that has a bunch of PPOs, patient organizations under it, those aren't going to be part of the plan. If they have a bunch of, HMO entities that are serving them, individual doctors' offices that are part of their plan, they're not going to necessarily be considered carriers, but rather they're going to be considered subcontractors under that plan. The other thing that's notable here, it says in order to be a large provider that the health benefits, services, and costs, or your total administrative costs, have to be reasonably expected to exceed 5% of the costs of the whole program if you're a carrier. Next slide, please. Another thing that I think is really interesting about this is, in the FAR, we have things called conflicts of interest. We have concepts called responsibility. In order to be eligible for a contract, you have to be responsible, which means you have to have the capabilities, controls, equipment, facilities, personnel, cash, etc., and experience needed to perform. Very similar here that, contractors, in order to be carriers, they have to meet the standards that OPM lays out. They have to have those capabilities that are needed in order for them to do the work. 1603 in the FEHB acquisition regulations provides for these carriers not to engage in improper business practices or personal conflicts of interest. As I say here, there's no individual personal conflict of interest provision under the FEH acquisition regulations, but there is in the FAR. So you go back to the FAR to look at what those kinds of personal conflicts of interest are. But with regard to improper business practices, it's really very important here that a big part of what a federal employee carrier does is it advertises. I'm sure you've been driving on the road, listening to WTOP or some other station, and a commercial comes up and it says, okay, it's open season. You get to pick your federal health plan. You know, I'm with, name your carrier, and here's why you should pick me. So this subpart actually goes to that and says, carriers cannot engage in misleading, deceptive, or unfair advertising. That would be a breach of the contract. That breach could lead to non-exercise of options, reductions in fee, etc. So there could be real consequences to misleading. Advertising must alert the federal employee and its annuitants to the options of the plans, and it has to be accurate. You can't be incomplete. You can't use inappropriate comparisons. You can't disparage or minimize other carriers as well. So we're really talking about basically the concept of no unfair trade practices here. You know, compete based on the actual terms and conditions. And as I mentioned previously, that plan brochure is the contractual statement of your benefits, limitations, and exclusions. Here I've listed some of the violations. Again, egregious repeated violations can result in suspension of new enrollments. You know, sort of like that concept of suspension debarment in federal contracting, where you're not allowed for a period of years in order to get new contracts. This could also be that kind of consequence here. You do have due process. There is a process for you to challenge if they do try to assert one of these things. So there is that as well. And there is a required flow down. So as I mentioned before, you have carriers and carriers have subcontractors. Be sure to flow down those terms and conditions because you don't want them engaging on your behalf in unfair competition activities. Next slide. Administration. So again, just like other federal contracts, there's record retention requirements, audit requirements. They've laid out the FAR provisions that apply here, but there's also an FEHB acquisition regulation that applies. You're required not only to retain all records regarding the agreement and performance, individual enrollee and patient claim records have to be maintained. You know, and there's a real question here as to, are these federal records or are these your federal employee health benefits provider records? And the way the regulation is written, it says these are not subject to the Privacy Act. These are records that are corporate records used for administration of the corporate program, but there is a responsibility to protect them so that they are not used improperly for purposes that are not approved of or allowed under the program. Health benefits claims, you know, we talk about the insurance program. Traditionally, insurance says, I'm going to insure you for certain kinds of medical costs, procedures, etc. On those costs and procedures, I'm going to pay you a certain percentage. You know, you can appeal it. You can seek to get coverage under some supplemental medical plan or whatever. But this is what, for my specific health benefit plan, this is what you get. So folks that are seeking to get those benefits, they will file health benefit claims, and the claims go into the healthcare provider, and the healthcare provider is charged with administering those claims. That carrier administers claims, and in administering the claims, they've got 6 months to challenge the claim dispensation that the carrier has issued. You know, in other words, you put in the claim, that form, you give the copies of the receipts for the medical procedure, you give the codes for what it is, and then the carrier will review it and they'll say yes, no, and give you money. Or if they say no, or they don't give you as much money as you think you're entitled to, you have 6 months to file a request for consideration. The carrier has 30 days to respond to that, and will send you something in writing, agreeing to pay you, asking for more information, or denying your claim. You then appeal that claim if you want to appeal it to the Office of Personnel Management, and OPM will issue a decision in 90 days. Notably, there's still another layer of potential judicial review if you want it. You get to actually file in district court against the Office of Personnel Management, not the carrier. At this point, it's gone to the OPM, and so if you do decide to seek some appeal, that's the route that you would go. Next slide. More on administrative matters. Experienced carriers are required to provide notice of any significant modifications. This means something happens that's going to impact, the cost that you're going to be charging, your overhead, your other kinds of expenses. You have to give notice to OPM, the contracting officer responsible for the program. As to that, they may ask for information. There may result in a modification. But before you're allowed to modify it, that pre-notice and approval process has to go through. You just can't change your rates. This is something where you have a contract and the contract says, here's the rates I'm going to do. It's just like a federal contract. You just don't change the terms and conditions of what you do to perform. If the government does it, it's a change. If you do it, it's a potential breach. So you really want to make sure that you're following these rules. Large provider agreements, in order to determine what's the impact of this, what rates do I charge. There's a variety of analysis. Some provider agreements are based on cost. Some are based on pricing, depending upon which contract you have. You have the FAR 52215-2 audit records provisions, which are those standard provisions that apply to government contractors. If you're doing it based on pricing, again, these are commercial healthcare systems, the FEHB acquisition regulations. Those provisions will apply here, and they will address all the different issues of audit. The flow down here, when you're dealing with these kinds of agreements, applies to underwriters, those folks that underwrite the insurance for the health benefit systems, those entities that are involved in paying claims and giving administrative services. Next slide. So 1605 and 1606. So this is a big difference between the Federal Employee Health Benefits Program and regular acquisitions. Typically no solicitations. They may have an open opportunity for you to seek to become a healthcare provider, but the OPM issues contracts under 5 U.S.C. 8903. That's different from other, like Competition and Contracting Act. This is a very different kind of thing. There's no competition required. They can have a number of different entities that get these contracts, and as I mentioned before, there are over 200 plans now on healthcare carriers and providers under the system. The way the contracts work, however, is you get a contract, and the contract is for a year, maybe longer, and it may have an automatic renewal provision absent notice that the carrier gives or absent notice that the government gives. The carrier has to be licensed in all 50 states as well as the District of Columbia, and they have to propose a plan that's going to comply with those OPM health benefit standards that I mentioned before, those minimum standards that are required. Contract can't discriminate like other government contractors. Carrier cannot discriminate on the basis of race, sex, health status, or age at the time of enrollment. You've got a certain period of time that, unlike other things, so like somebody might have a healthcare plan and they want to switch. Remember, we talked about open seasons. So there is a period of time where you might convert to a different contract, a non-group contract. And so the contract does provide, and the regulations provide for that period of time to kind of move you over, but maintain that insurance. Carriers can only cancel a healthcare recipient, like one of those members who has participation in the plan. Remember, the employee, the spouse, the children, the former spouses, they can only cancel the benefits coverage where there's been fraud, where there's been overinsurance or non-payment of the costs under the contract. Rates, as I mentioned before, those are dependent on the method of calculation for the particular health benefit plan, but they have to be reasonable and equitable and reasonably reflect the costs of the benefits that are being provided. There are certain things, this makes it different from other kinds of contracting. So in the federal sphere, sometimes we see things that are socioeconomic plans in government contracts where they give preference to particular types of entities. Here in the healthcare plan, They're actually things that are disapproved that they cannot pay benefits for. In this case, assisted suicide is one of those things that's on that term. Next slide. So contractor qualifications, what does it take to be a carrier? So you have to not be debarred or suspended or proposed for debarment or suspension or otherwise declared ineligible. So if you've been convicted of a crime, if you've been indicted, if you've been civilly charged, these are things that may affect your present responsibility in order to be eligible for one of these healthcare plan contracts. In addition, you have to not be terminated for default. I mean, this is, termination for default may not be an automatic disqualifier in a regular government contract, but here it provides that if you have been terminated for default by any federal agency, then you wouldn't meet the qualifications to be a carrier here. So something very important to note. Principles of the carrier include officers, directors, owners, partners, and persons with management or supervisory experience. Representatives are identified here in the slide. In addition, one of the key things I have it bolded, representations are identified to be material. So the significance of that is the False Claims Act, which applies to a situation where the government pays funds out to a contractor or other entity. So if there is fraud, if there is an intentional or reckless disregard of the truth of something, and the representation is material to the payment of the funds or the government's action or inaction, that could be a violation of the False Claims Act. So here, when you are applying for a contract, when you're putting in, here's my costs, here's my health benefit plan, here's what I'm doing, here's my decisions, whatever, all these representations that you're making about your status and the payments that are due and owing you, those representations are deemed to be material. So that eliminates a proof level for a government entity that might be suing a health carrier. So they don't have to prove anymore that there's been a material representation in order to find there's been a violation of the False Claims Act. That's already something that is conceded because it's written into the FEHB acquisition regulations. I mentioned before that there are minimum standards for carriers. The failure to maintain those minimum standards can result in the loss of the carrier contract, some withdrawal of approval, or proposals for corrective action. As I mentioned before, there is a mechanism for due process, and so if something happens, your status changes, the government tries to take action, there is a mechanism to address that. Next slide. So source selection, again, unlike government contracts, no competition. FAR Part 15, which is negotiated procurements, really doesn't apply here. Chapter 89 of 5 USC and 5 CFR, those are the ones that govern, and you have to meet minimum standards. So pretty kind of different, but very clear as to what you have to do. Next slide. Contract pricing, this is the thing I'm not going to get into a lot of because it gets very complicated with a lot of different terms, and we don't have quite that much time today to go through all of that. But the FAR does supplement the Federal Employee Health Benefits Acquisition Regulations here. That's FAR Part 15.4. I'm sure a lot of you are aware of 15.404, which is like how you calculate profits. In addition, there are other provisions that may or may not apply. Cost of pricing data isn't required typically. However, a contracting officer can require the provision of custom pricing data or other than custom pricing data to establish the reasonableness and fairness of the prices that are being sought to be charged under the plan. As it says here, pricing of premiums and subscriptions can be based on experience, and that's experience not like how many years of experience do I have, but rather what does it normally cost? What is the cost experience of the plan in being administered? So submitting rates is based on my historicals, like what does it cost me generally? What are my overhead, administrative costs, my healthcare provider costs, et cetera? What are the likely kinds of impacts in terms of the claims that are submitted, the amounts that are paid out? Contracts are for greater than 1,500 enrollee contracts. This is where you're dealing with the price reasonableness based on experience. And OPM requires that you identify a similarly sized subscriber group. That may trigger, for some of you who know the GSA schedule, Federal Supply Schedule, that may trigger kind of like an aha moment that in the GSA contracting sphere, we have most favored customers. And to have most favored customer clauses requires you to identify what is a substantially similar target group so that in the commercial sector, as I am charging things in that sector, I'm promising the GSA, for example, that I'm going to be charging those rates or lower rates, so that becomes the target of what it is you charge. Here, when you're calculating what your experience pricing is, you're going to be looking at that comparable experience. What's that experience factor that's happened before, and why am I charging those rates? This medical loss ratio, again, it's sort of like how many claims are being made, how much money is being paid out. That's the kind of things that they're looking for. Next slide. So profits, as I mentioned before, you got 15404 in the FAR. Here we have the FEHB 1615.404, very similar analysis to the FAR weighted guidelines, determining the reasonableness of pricing and profit depending upon your cost experience, your compliance, your customer service, your resource use, and your contract oversight. Notably, in this regulation, it says the sum of a maximum score for a profit analysis is 1%. So we're not talking huge profits here. We're talking analyzing to determine profitability with a maximum score of 1%. You're required to certify. So again, we were talking about that materiality question of anything that you represent is going to be deemed material. Here, the pricing you're giving in, those certifications are going to be deemed material. And if there is defective pricing, just like in the GSA schedule, you fail to disclose current, accurate, and complete cost or pricing data. You know, there are important things that are out there that would make a difference in how the government would assess and calculate or accept the rates you're proposing. If you fail to give that, there could be a basis for a defective pricing or defective a false claim. So those are things always to be noted. You really want to make sure that when you're doing this pricing, you're addressing everything that you need to address. Next slide. I've mentioned before the FAR 15.4 pricing supplement. No cost or pricing data is required. The contracting officer can still require it, and certifications, you know, where they're submitted will deem material. Next slide. Investment income. This is another piece where, you know, remember I was talking about that first case that I had? Well, that first case dealt with a mandatory state statutory reserve issue. In that case that I had way back when, the state statutory reserve actually was one that was required by several states, and the states then repealed the reserve requirement. And the question was, what happens to the money? Well, now we have the Federal Employee Health Benefits Rule 1615-70, which tells you what happens with that. And it says that investment income is to be credited to a special reserve. You know, when they have money, you have these funds that are available, and the funds that are available have to be segregated. They can't be commingled unless you have an appropriate accounting system set up that's been approved by OPM. So typically, if you have funds that exceed your present obligations, those are put in a special FEHB reserve or a reserve for unpaid claims, so that there's money that's available in case there are claims. The healthcare carrier is required to invest or credit this reserve for that income. And if you haven't put the money into the special reserve to earn that interest, et cetera, then you will be subject to a claim by OPM to pay it back. The fiduciary duty of a carrier is to invest this money so that there's money available in case there are obligations. If the investment income is lost as a result of an unallowable, unallocable, or unreasonable charge or failure to credit the funds, then the carrier is going to be required to repay them. And this provision on investment of funds is also included as a mandatory in the underwriter agreement, those entities that underwrite the insurance claims, and that if there is something that gets called, it's almost like bonding, that they will underwrite and pay out. Next slide. Types of contracts. So as it says here, negotiated benefits contracts, there's a community rated one, which is based on the cost and price analysis. And then there's an experience one, which is based on, as I mentioned before, that cost experience of how much does it cost to run a program. Negotiated benefits have their own special section on accounting and pricing adjustments and allowable costs, as it's indicated here. That's 1616-70, and there are actually separate clauses, 1652, 216, 70, and 71 that cover those. Next slide. So labor laws and policies. Labor laws apply here. So you have to comply with federal labor laws when you're dealing with federal health insurance benefit programs, your carriers, the employees for your carriers and subcontractors, those rules will apply. As we mentioned previously, you're required to give notice of significant events. Here, significant events include not just labor law kinds of issues, but disposal of major assets, a loss of membership. Remember, we're talking about that experience factor of you're being charged based on 1,500 or more members in your plan, et cetera. If you lost 15% of your membership, that could be significant. It could impact your rates. It could impact your costs, obviously. So those are things you're required to give notice of. In addition, you're required to give notice of any terminations of contracts or subcontracts or provider agreements or underwriter agreements, things that would make a difference. Next slide. Sorry, tickle in my throat. Protection of privacy and Foia. I mentioned before, Privacy Act doesn't apply, but you have a confidentiality of records requirement that you are required to comply with. As it says here, the carrier has to hold all medical records and information relating to them confidentially in this day and age where there's an increasing amount of cybersecurity issues out there. Stay tuned. The current FEHB acquisition regulations do not include specific regulations in cybersecurity, and the current FAR only includes like 52.204- I think it's 21, a very limited set of like 15 factors from the NIST SP 800-171 security control standard. However, I do expect that there will be increased attention in future years, and probably even closer than that if it isn't already, to maintaining the sanctity of records, the cybersecurity of records. So stay tuned, because although it's not there, I very much expect that that's going to be coming sometime soon. Next slide. So contract cost principles, again, it's a little bit different, but it's a little bit the same. So FAR Part 31 covers the typical costs that are allowable, allocable, and reasonable under government contracts, and the ones that aren't. Notably here, you know, we talked a little bit before about things like advertising costs. Those are definitely included in the allowable range here, because advertising, letting people know during open season what they've got, et cetera, those are really important functions that the health benefits carrier provides to let people know what insurance programs are out there, what their requirements and benefits are, so that they then could choose which one they're going to comply with. Allocation methods for allocating different business unit indirect costs. That's again very similar to what we see in the far side of things for regular government contracts. And as I mentioned here, certain costs, not just public relations and advertising costs, but interest expense for that FEHB investment portfolio in addition to the special reserves to make sure that you have the money available to pay on those benefits. That's important. And selling costs for open season and creating that FEHB handbook and brochure. Those are all allowable kinds of costs out there. They do provide the Chapter contracting officer advance approval if you're going to be spending more than $1,000 annually on trade, business, technical, or professional activities that are going to be allocated as indirect costs under the FEHB plan. And remember, I mentioned mandatory state statutory reserves. So mandatory statutory reserves, to the extent that they're allocable to a contract, those will be addressed and have to be paid into. When a reserve is no longer required, the statute and regulation now provide that the funds will be available for the carrier's general use on a pro rata basis, and the government will get its share of those funds from the statutory reserve returned to them for their use in the plan as well. Next slide. So contract funding, there is a contingency reserve that's out there. I think no matter what, federal employees have a pretty good health benefits plan. There's a lot of like self-insuring in the government when you do government contracting. So there are contingency reserves if there's some unexpected thing that happens to make sure that funds are going to be available so people are protected for their health benefit plans. Notably here, we have something called assignment of claims. You have that under a FAR provision for normal government contracts as well. Here, you can't assign any claims under the, meaning any payments. You can't assign any payments under the contract without the prior approval of the contracting officer. Any approval for that kind of assignment where they'll be able to, take some kind of like assignment of the amounts that are owing you as a carrier. That only is good for 1 year. You have to reapply again. It's not something that gets automatically renewed. You gotta reapply. The other thing that's really interesting here is, let's say a carrier goes and merges with another carrier, or a carrier is selling itself to another entity. There could be a provision in here where the government says, well, I'm not ending and I'm not novating right now. We're in the middle of a health benefits year. So instead, I'm going to require that you continue performing operations and that the successor of interest doesn't take over till the following year. So under some of those rules out there where there is a novation pending and the government says, I don't want to recognize that successor in interest right now, and I don't want to terminate you, they could actually bring in somebody else as a third party to continue the administration of the day-to-day contract. So that's a little bit of a twist. I can't say I've ever had to deal with that, but 1642 contract administration, that's where you'll find that provision. Next slide. Subcontracting. So you got to flow things down. That's always important. You have to make sure that you have subcontractors that are responsible and can do the things that you require of them. So that's a carrier function. A carrier has to follow commercially reasonable procurement procedures in order to acquire commercial and non-commercial things for the performance of its contracts. There's always this challenge in government contracting as who's a subcontractor, who's a vendor. It's just really important that you accurately flow down requirements. Make sure that you're really identifying who those subs are that are required to get those flow downs. For experience rated contracts, the contractor has to notify the contracting officer at least 30 days in advance of entering into a subcontract that's going to be greater than $550,000 and greater than 25% of the total subcontract costs. So, TINA adjustments occur, the number can go up, but for experience rated contracts, that advance notice when you're going to enter into a subcontract is key. Failure to notify could lead to disallowance of your subcontractor costs and potentially imposition of a penalty or reduction in your service charges that you're being issued. Remember, we talked about that calculation of fee and service charges. It could lead to a reduction of that if you're not administering the contract correctly, not giving timely notice, and an opportunity for the government to reject or approve a particular subcontractor. Next slide. Anyway, there are a lot of different issues in federal employee health benefits. We've really touched the surface. We've talked about the federal employee health benefits acquisition regulations. There are a lot more rules that are out there, and the devil is always in the details. So take care when you're entering into this realm. If you have questions, don't hesitate to reach out and seek some help. In the meantime, have a great day, and nice talking to you.
Susan, thank you so much. It was a great presentation. There's obviously a lot to FEHB, which I did not realize. So thank you for giving us a comprehensive overview in a very clear and concise format, as you always do. If anybody has any questions about today's presentation or has any government contracting questions that you want to run past Susan, her contact information is here. You've got her email, you've got her phone number. Today's session has been recorded. We will have it up on our YouTube channel and on our website, usually within 24 hours. Typically, it's up within the next hour or two. So feel free to check our website or subscribe to the YouTube channel. You'll get an alert as to when that has been posted. So thanks again, Susan, and we hope to see everybody again next, actually on Friday when we cover the playbook, and then next week for the series, I think we are covering GSA, if I'm not mistaken, next week. So thanks, Susan, thanks to the attendees, and we'll talk to you next time.
Have a great day. Thanks, Jennifer.
Thanks, Susan. Bye-bye.